All right, looks like the number is settling down now. All right. Well, welcome everybody. It's good to see you, quote unquote. Thanks for coming to today's webinar on saving and investing. I'm really glad you showed up. It's a really important topic, and my hope is that by the end of our time together today, you're going to feel more comfortable, more confident, and more capable of making smart saving and investing decisions that are going to support your financial future. So first things first, before we get started, my name is Sarah Metzger. I am one of the assistant directors at the Sokolov-Miller Family Financial and Life Skills Center. Really happy to be back with you today. We also have our director, Julie Heaton, in on the call. Julie is going to be managing the chat and the Q&A. So if you have questions, and I'm sure you have plenty, do not be shy about sending questions to the Q&A. You can send them anonymously if you'd like. You can also upvote and comment on questions. So if you'd like to piggyback, you are welcome to do so. We are also recording today's session as a note for housekeeping. So if you have to step out early, not a problem whatsoever. You can come back to our YouTube channel and finish where you left off, or have a refresher for yourself down the road if you need to. We typically have these recordings posted by the end of the week, and I'm sending to you all the link to our YouTube page plus a bunch of others. Oops, hopefully we'll see here. How does that come through? All right, that looks good. Okay, so you've got the link to the YouTube page. Perfect, thank you for the thumbs up. I also will note for any students who are attending today for SMEAL's Ethical Leadership Challenge, you do not need to scan a QR code or do anything special. We will let the program managers know that you were here in attendance today. So just sit back, relax, and enjoy our talk on saving and investing this afternoon. Okay. All right. And Julie, if I forgot anything, please stop me or let me know in the chat. I'm a little rusty. It's been a minute, y'all, since I've hosted a webinar. I used to do this regularly, but not anymore. So we're going to shake the rust off, keep it moving, dive right in here. So we're going to start with just a quick mention about financial wellness, because I'd be remiss to talk about saving and investing and not, or talk about it exclusively like it's in a vacuum, and it's not. It really is one piece of financial wellness, or what we can leverage to reach financial wellness. And I want you to think of that journey like climbing a ladder. Those of you who've been in attendance with, us in the past for our other webinars, you've seen this ladder before. Every step you take builds on the last. You begin with a budget, you open a savings account, and as you keep climbing, you plan for your future, you find opportunities to invest and grow your wealth. And that's what we're going to touch on here today. So please keep in mind that, like, I'm talking high levels in personal finance on this journey that we're on for the most part today. But certainly if you don't have a working budget, or you're feeling really uncertain or stressed out about getting just your day-to-day expenses covered, start there. Start there. Come check in with us. I'll talk about our services at the end if you're not familiar with them. But just remember that this is a journey. There are multiple steps on this process, and it's okay to slow down, move at your own pace, or take a backward step down the ladder if you need. I always have 3 points of contact, frankly, 4 points of contact at all times. I've always got a foot on budgeting myself, so don't worry. That is totally normal. So with that context in mind, we're going to look more closely at rungs 1, 2, 4, and 5 today. We talk about learning more about personal finance, how we can act on saving and investing, and really then building stability in each of those 4 rungs. So let's go ahead and jump in. First up, let's talk saving. So saving is about more than just holding on to money. It's about building a foundation for yourself and providing options for yourself. And when you give yourself options, you're really giving yourself freedom in turn, which is exciting and something that we hope for, we strive for when seeking financial wellness. That's one key piece. We have freedom of choice with our money. So you're going to use your saved money to follow your passions, reach those goals, achieve the things that you want to achieve, to travel, to tell your boss, that's it, I'm out. And you've got the money saved to say, like, okay, I'm just going to quit today because I can't handle this anymore. This isn't good for me or whatever. I've heard it called, and part of my French, the FU money. I've read that in a ton of different books. Folks like to talk about having FU money. We save because that might be one of our goals. So that's one really important reason. We also, use this save money to reach into our savings account, dip in when our car breaks down, or that once a year registration payment comes along, which mine is actually going to be coming up here in August. So I have to not forget that as I go through my budget this summer and I save for that, right? What is one thing that so thinking about like why we save money, I'd love for you to go to the chat and get engaged with me here. What is one thing that you all would spend money on today that would make your life easier or more enjoyable? Because that's one reason that we save. That was the first I brought up. Goals are really important, and money opens doors for us in life and opportunities and access to things. Hop over to the chat. What's one thing you'd spend money on today that would make life easier or more enjoyable? And if we have saved money, that can be a reality. Vacation, golf. Did you watch the Masters this last weekend? It was great to see Rory win finally. Golf trips. Okay. Oh, you all have some really interesting passions. Ping pong paddle. I don't know anything about that, but I know that it is a real intense sport for those who play. NFL game tickets. I'm a Bears fan myself. Unfortunately, I understand that cost. Okay. A lot of golfers in the room today. I also understand those expenses. Okay, cool. So you all have the vision in your head of these things that you want to do, things that would make life easier or more enjoyable. Great. Save for that. That is what should be driving you to save money. That and then all the other practical things. My car could break down or I have registration to pay, right? These are the reasons that we save. Now, saving money in an account, it gives us an added benefit of compounding interest. So this is the magic of compounding, and this is what makes saving our money with a bank or a credit union or investing it really enticing. Compound interest, for those of you that might be new to this concept, is when you earn interest on both the money you've saved and interest on the interest you earn along the way. Earning interest on interest. Interest is the money that the bank pays you for your deposit. So when we take our money to the bank or the credit union, or when we invest in the market, but definitely when we go to the bank and we drop off our money in a savings account, the bank is paying us a little for that deposit. Because in the meantime, while our money just sits around, they're actually using it for other things, but they're paying us for that privilege that we give them of like, here's my deposit, use it, but pay me a little bit while it sits in the bank, right? That is really exciting stuff. Let me give you an example of this. Let's talk real numbers here. If you have $100 and it earns 5%, let's say in a high yield savings account each year, you're going to have $105 at the end of the first year that you've now accrued, right? Your balance went from 100 to 105. At the end of the second year, you'll have $110.25. So not only did you earn $5 on the initial $100 deposit, so that's that 5% interest got you an extra $5, you're also earning 25 cents on the $5 in interest, which is more free money. So for saving and for investments, compound interest is really your friend, as it is multiplying your money at an accelerated rate. And the earlier you get started, the sooner you get your money into an account that's compounding, the more years you allow for that interest to grow, the more that you benefit. And I have on the screen a QR code for those of you who have 2 devices up. You can scan and access a compound interest calculator that's going to give you a nice illustration of this. I'm also going to drop a compound interest calculator into the chat from the website NerdWallet. There are a ton of these calculators out there. Let me see if I'm able to play around with this. I'm going to bring this guy over here so you all can see what this looks like. Let's say I put $250 in and I let this money sit for the next, I don't know, 30 years. And every month I add an extra $250. And let's say I am getting 5% on that return. When you take a look at this graphic, it's showing, okay, well, you've put in $90,000 over the 30 years in those deposits, but you've earned in interest $118,000, bringing your total balance to $209,000. That is really exciting, and it feels a little magical, which is why we call it the magic of compound interest. This is why we don't typically keep money under the bed. Some of us do, and I've got a coin jar at home with some cash in it, so no shame there. But when we put our money into an account, we're able to reap these benefits. I'm going to talk a little bit more about those accounts. Where exactly can I benefit from this particular magic that you're describing, right? All right, so let's move forward on this guy here, okay? So you have, oh good, I've got it up on screen. Great. I have a slight delay on my end. So you have a couple of tools available to help you all save. And I know we've got a mix of undergrad students, grad students, staff, faculty, alumni. Some of you are going to be further in on your personal finance journey and already take advantage of these accounts. But if this is new to you, make sure that you are taking good note here on what account you're going to investigate opening in the next couple of weeks or months, or your summer break plan here. You've got regular savings accounts available to you, high yield savings accounts, you've got money market accounts. These are all accounts that your bank is going to offer to you. Very easy to open. They have some rules about minimum deposits or how frequently you can take money in and out of them. But these are the kinds of accounts that are going to give you that added benefit of interest. Okay. Now, I will make a note too that high yield savings accounts often have a nice, much higher interest rate than a standard savings account. So many people, if you ask around, talk to your friends, talk to family members or mentors that you have in your life, you'll often hear that, oh yeah, I've got my savings account and then I've got a high yield savings account with a different bank online. Well, that high yield savings account is providing a higher interest rate, which means more free money added into your account every year. So be a choosy consumer when you're out there and you're searching for the bank that you'd like to work with in the account that you'd like to open. Do the research on what those interest rates are and what you can anticipate getting in return for your deposit, because you have choices. You have lots of choices out there. And know that when you put your money in something like a savings account, a high yield savings account with an institution that's FDIC insured, or it's a credit union that has insurance backing, that your money is safe there. Safer than it would just be sitting in the jar on your desk or in a box under your mattress, okay? Now, I will recommend, as you all are thinking, okay, so I have this account, great, check, or I need to get this account open for myself. Okay, good plan. Consider automating your savings if you don't already. So this is going to be a small, medium, large recurring transfer from your checking to your savings on a monthly or weekly or quarterly basis, whatever works for you. This makes saving so much easier, especially when payday comes around. We get paid once a month here at Penn State in my position. And so I have that automatic transfer turned on so that it's like, set it and forget it, make sure that I save. That way I don't get to the end of the month and spend all of my money on expenses and extra stuff and go, oops, I have nothing left to save. Nobody wants to get stuck in that position, right? And a general rule of thumb here when you're thinking about how to save is try to save at least 3 months worth of your monthly minimum expenses for things like emergencies. So start wherever you're at. And remember that like one of the main reasons why we save is for those unexpected expenses, like your car breaks down, you have a medical bill that's much higher than you anticipated, something that I'm personally dealing with right now. Things like that. My husband's car got hit by a bunch of garbage cans in that big storm we had a couple weeks ago. Just like life is so random, you want to be ready for it. And 3 months of your minimum expenses is going to make sure that, like, if you were to lose your job or have a really big unexpected expense, you're generally prepared to cover it. Okay. My last note on this slide is to say to you, look at your savings account, especially if you only have one, and think of it like a bucket, as you see on the screen here. So you're putting this money in every week, every month, however often, and you have it earmarked for some of those big ticket items I had on my earlier slide, short-term goals, periodic expenses, and the rainy day fund. Please make sure that you know how much is earmarked for each, and that rainy day fund is all the way at the bottom, quote unquote, right? It's not actually a bucket of money, but I want you thinking, okay, emergency fund, like that's money that I tap into last. That's not money I pull out and transfer so that I can go to Chick-fil-A and hang out with my friends this weekend and grab a bite, right? Like that is money that I don't touch unless I absolutely need it for the rainy days. I think this analogy is useful and it helps to remind us that like we might have $1,000 in the account, but that is not just some random amount of, $1,000. Everything is earmarked. All of those dollars are meant to serve a specific purpose. Hold yourself accountable to those purposes that you set for yourself, okay? So that's my note on how you can save and how to think about saving. If you have questions about any of that, please go to the chat. I lost my chat. I don't know where it went, but I know Julie is hanging out with us and she can help to field some of those questions. I'll have to find my chat in a little bit. I don't know where it went. But for now, let's continue on. And then start to ask ourselves, okay, well, will saving be enough for things like retirement, marriage, having children, raising children, buying a house, and just generally building wealth for ourselves, for our future generations, like the ability to leave a legacy? Let's go to the chat really quick. And let's just make this a really binary question. Will saving be enough to cover these expenses? Yes or no, in your opinion? I want to see kind of where we're at as a group. No, no. Any other no's or yeses? So far, no's. Okay. I would agree with you. I would say that saving is not going to be enough in most cases. For the average person, I would say. Why? Does anybody know why saving isn't going to be enough when we talk just about saving money in our regular savings account or those high yield savings account? Anybody got an answer in the chat? You know this. You feel it every day. You see it every day. Okay, I'll tell you. I'll tell you. I don't know if that sound played for you, but it did for me. And that just scared me because I forgot that I had the thunder, the thunderclap sound. So inflation is going to be a real savings killer. Inflation is what makes it difficult to exclusively save for things like retirement, home buying, raising a child. The average home price in the US right now is a little under 500,000. Weddings, average cost of a wedding in the US is about $33,000. Children cost over $200,000 or more to raise over the course of like 17 to 18 years. And certainly, those of you who have children in college right now, Some of you, if not all of you, are still providing some amount of support to them beyond the age of 18. So there's some really expensive big ticket items in our horizon that we want to be able to afford, and saving is not necessarily going to be enough. And this is where we start to pivot into the world of investing. I'm talking about investing as something to leverage to make sure we can afford things like home buying, raising kids, and retirement, which retirement, $1 million or more for somebody nowadays. And that's in today's dollars. And I think about my great grandmother. I always tell people my great grandmother who lived to be 104, if I live to be, well, if I retire at 60 and live another 44 years, like that's 44 years of life I have to have replacement income for. I have to be able to pay myself and dip into what I have saved and what continues to save and generate as interest over those 44 years. So that's a lot of time and something we want to plan for. You all do. Okay. Even if your goal is not to retire at 60, maybe 70, or maybe keep working forever. I don't know. We want to plan for the future we envision for ourselves, and it's going to cost money. Now, before I move on, if you are super curious to see about how inflation is impacting your savings account, I'm putting into the chat a Fifth Third savings calculator with inflation taken into account. It is one of the saddest financial calculators you will ever see. Every time I bring it into classes and I talk with students, it is a big downer. But we turn it around and we start talking about, okay, well, how do we beat inflation? How does investing help us to beat inflation? So, all right. Before I move into the nuts and bolts of investing, though, I do just want to emphasize or give you a little bit more information about why inflation is eating away at our purchasing power over time. A couple things to consider. We've got APY, that annual percentage yield. That is what you are getting as a return on your deposit at the bank or as a return on your investment in the market. And then we've got inflation, which right now is a little over 2%. If you are not getting an APY percentage that is higher than inflation, you are going to start losing purchasing power on the dollars in your account. Even if you continue to see your account growing in value, which you will, the number is still, that balance is going to increase, but things around us, goods and services, continue to become so expensive that our dollar just doesn't stretch as far. Now, right now, traditional savings accounts have an average APY of a little over 0.4%. So 0.41% is where we're at. So a fraction of a percent. I know that I have one traditional savings account still in my portfolio, and it's something like 0.15%. I've heard of folks who have, even smaller percentages than that. So we're not necessarily getting a ton in interest on our traditional, those standard accounts. This is why I mentioned high yield accounts and money market accounts earlier. So you are able to be choosy and look for places to save your money that are going to give you the biggest return on your investment or on your deposit. Okay. Now, inflation is targeted to be about 2%. That's where the Fed tries to keep it. So we're actually getting into better territory as of late. Certainly, if you've been around in the last several months and couple of years, you've seen inflation skyrocket. We all felt that. And we still see elements of inflation pop up in certain products, even if inflation is generally under control. Like bird flu came around and we've seen the price of eggs skyrocket. So a lot to kind of take into consideration there, but this is like overview of like what is going on with our savings accounts with inflation in mind over the long term. We don't want inflation to hurt the value of our savings, so we look for ways to beat it. And this is where we start to move into the world of investing. And now that you've saved money too, like let's also be clear, if you've saved money into your savings account and it's earmarked specifically for investing, if it's not tagged to your periodic expenses or other goals that are more short term or emergency funds, like this is money that you can invest. You have the capital because you went about saving. So that's step one. Now, if you're ready and you want to make a move into the space of investing, let's talk about how to do that. Planning for the future and saving up for those big ticket items is so important. There's a saying that we have at the center here, and it's on all of our saving and investing presentations. Every time we talk about this step of the ladder, do something today that your future self will thank you for. If you know the future is going to be expensive, take action today. Do something small, be intentional with your saving, and that can lead to more security, flexibility, freedom, and peace later on down the road, whether that's 5 years, 10 years, 25 or more years down the road. Because I know you all have different time horizons since we have a diverse group in attendance here today. So let's talk about what that thing is that we like to say, like, okay, we'll do something today your future self will thank you for. We go into then saying, well, consider saving and investing early and often if you haven't already considered doing so. And here's an illustration that's going to help to explain why. I've got 3 folks on the screen here, Talia, Jess, and Nate. The question is, between the 3, who's going to earn the largest investment return by age 65? So you've got 3 investors here. They're investing, let's see here, Talia, $5,000 annually for 30 years, Jess, $5,000 annually for 10 years, and Nate, $5,000 annually for 40 years. So they're investing the same amount per year. Read through those profiles and then pop into the chat who you think is going to earn the largest return by age 65. And then we'll talk strategy here. Okay. Excellent. Oh, I'm about to hand the mic over. Y'all know this. Y'all are right. Nate is netting that largest return. Okay. All right, good. So you all know that Nate is going to have the largest return by age 65 after, in his case, 40 years of investing. Let me ask you this, though. Who's coming next? Who's going to have the second largest investment between Jess and Talia? So Nate might have been more obvious, but I want you to look at Talia and Jess and their profiles as investors. And who do you think between the 2 of them is going to have the next highest return? And this is where we've got some split answers coming in here. Jess, Talia, take a guess here. Read through again. Okay. If you all said that Jess, see? I think I have a feeling why some of us thought Talia was going to have the second highest return. We'll talk about this. It's actually Jess who has the second largest return. Now, I know some of you looked at how much they invested overall and you said, oh, well, Talia invested just $50,000 less than Nate. Surely she's going to have the second largest return, but that's not the case. In this case, you actually see Jess investing $100,000 less dollars than Talia, but because she started 10 years earlier, she had more money, or sorry, she had more time in the market to take advantage of those compounding returns and that exponential growth. So we call this the time value of money. And what this is getting at is that the earlier we invest and the more regularly we invest, the greatest potential we have for a big return on our investment down the road. Now, those of you who are sitting in on the call and you're like me and you're turning 35 this year, and this is maybe starting to make you sweat a little and go, well, I don't have a time machine. I can't go back and be 25 years old again. I don't want you to think that all hope is lost, because that's not the case. It is still possible to have a return like Nate, even though you're starting a little bit later in life. It just requires a slightly different approach to your investing. It might, require you to check in with the free financial advisors that Penn State offers through its retirement plan and to get a little bit more guidance. And that's okay. And that could be true for somebody who's 25 as well. We'll talk a little bit more about that. But I just want to make this illustration clear. We talked time value of money. The earlier we start and the more regularly invest, the greater potential we have for a big return on our investment. It is the magic of time and those compounding returns. Yes, thank you, Julie. Compounding interest in all caps for real. So let's keep it moving here. We're going to talk long range investing. We're going to talk big goal investing for retirement, and retirement is so pricey. It is one of the biggest expenses we will all have, and a major goal that I know many of us share is that we want to have enough money to pay for expenses for the rest of our lives. We want to have that replacement income ready to rock and roll when we say it's time to go. It's time to hang it up. It's time for me to move to my beach house and, enjoy my beverages and my dogs running around in the backyard and grandkids or whatever for the rest of my days here. Okay. So how do we do that? How do we invest for retirement? Well, those of you who are already here at Penn State or you're working for a different employer as an alum, you probably have an employer sponsored plan like a 401k or a 403b. The real awesome benefit of being in the workforce is that many employers, as a benefit, provide us with some sort of retirement plan. And in some cases, they'll even match contributions. So we're putting money into that retirement investment account so that we can have huge returns on our investments down the road and then have enough money to retire. Sometimes our employers are contributing as well, or have match programs where if we contribute a certain percentage, they'll put that same percentage in as well. And that's free money getting added into those types of investment accounts. And that is really exciting. Those of you who work at Penn State, I've got the number for TIAA as well as SERS. So those of you who have the ARP with TIAA, that alternate retirement plan, call them up. Schedule one of those free appointments with the financial advisors that TIAA offers and have a conversation about what's going on within your investment account so that you better understand and feel informed as you make decisions with it, or you monitor to see how it's been changing lately and may change in the future. SERS is there as well for those who are part of SERS. PSERS, I'm part of PSERS, also has a number online that you can reach out. Okay, so we've got the employer side of things. But I'm going to talk to everybody today because I know that we've got undergrad and grad students in the call who are not working full time and may not have access to these types of accounts. Okay, well, let's talk about a retirement investment account that everybody can access, and that's an IRA, an individual retirement account. There are Roth and traditional types. Each has different tax advantages, which I'm going to show you in just a moment. And what's also worth noting is that funds within these accounts, though they're generally required to stay in the account until retirement, there are some IRS exceptions for early withdrawals. And one of those exceptions includes taking out money for your first time home purchase, which is really exciting. And certainly with the average home price of a house in the US being near $500,000, it's not surprising and actually is rather enticing to think that like, oh, well, I can save in a retirement investment account, take advantage of compounding returns, and take some of this money out early just to help me buy my first house. Sweet, what a deal. And that is a deal that the government has extended to us through these IRS exceptions. So thank you. Let's talk about the tax advantages for each of these because I mentioned that there are tax advantages. So we've got your individual retirement account. Let's say you've opened this account for yourself. And I'll talk about how to do that in just a moment. But know the tax benefits and start thinking about how these different benefits may be more advantageous for you. So you can decide to open one type of IRA or both, Roth versus traditional. The choice is yours. So when you have a Roth IRA, what you are doing is you are contributing post-tax dollars into that account. So you get paid, and some of that paycheck goes to taxes. We see that, makes us a little sad when we look at our paychecks. Then whatever is left over, you can put towards your Roth. That money in your Roth IRA, hopefully, and as we expect it to, or hope that it will, because it's invested, will grow and compound over time. And then when we go to take that money out at age 59 and a half for retirement, whoops, we don't have to we don't have to pay taxes at that point on the withdrawals because we've already paid before we put the money in the first place. So that's a Roth. And this may be um, an account type that makes more sense if you're a younger person who's in a lower tax bracket because your tax savings lie in that you are paying less in taxes now than you foreseeably will in the future when you're earning a higher income and you're making those withdrawals in retirement. A traditional IRA works differently in that you are contributing pre-tax dollars into this investment account, and that money is going to grow over time. And when it's time to withdraw after age 59 and a half, you're paying taxes at that time. So what's the benefit? Well, putting in your pre-tax dollars year over year is lowering your taxable income, which could in turn lower your tax bill. Which type of account is right for you? I can't say, but certainly you've got some of the language to get out there and do research and figure out, or talk to, one of the financial advisors offered through TIAA or somebody through your bank or financial institution to figure out, okay, which of these might be best for me. They've got benefits built in, maybe both, maybe one or the other, but I want you to explore those options because they are out there for you. And we all can take advantage of an IRA as a way to fast track our investment savings for retirement. So, those of you who are in undergrad or grad school, you don't have to wait until you hit the workforce full time to start saving and investing for something like retirement. You don't have to wait. And as we saw in the Nate scenario earlier, you may not wish to. You may wish to jump on this now and start taking advantage of the time that you have before retirement to get more compounding returns. So, that said, let's hop into how do I invest? So, we've got an account in mind. We're going to use IRA as our scenario for the remainder of this presentation. So, you are going to figure out how much to put into that account, how much to invest. You're going to get the account open. You're going to pick your investment mix based on risk tolerance. And then you may over time decide to change up your investments. This process is not particularly difficult to do in terms of like logistics. What I'm talking about here is downloading an app and picking some investments to buy into and then making changes over time. It's a matter of a couple clicks on your phone. So, knowing whether or not we trust the decisions we make or how confident we feel, that's a different story. But the process itself is actually rather simple. And frankly, you don't need to be an expert, you just need to be willing to start. And that's where a lot of us began. That is certainly where I began in my investment journey. I will own that 100%. So let's pop over. Let's talk about opening that account. Now, I've been talking about IRAs, these individual retirement accounts, and these are going to be the folders in which you invest your money into stocks, bonds, real estate. You hold your investments within your IRA, but you don't go to the bank and say, "Can I have an IRA?" You actually have to, well, bad example. You don't go into your app store on your phone and search IRA. There's no IRA apps out there. What you're going to need to do is you're going to need to find a brokerage app to download or a financial advisor to work with in order to open that IRA to begin with, within which you can then begin investing. So think of this as like step one, get the file cabinet. Step two is the folder, which is the IRA. You already know, okay, I would like to open an IRA, but you need the file cabinet first to keep it in. And that is going to be an app of some kind or a real person. So let's talk what's on the screen here really briefly. You've got brokers, a brokerage account. Full service brokers, if you download a full service broker app, they're going to offer a range of services. They'll have investment advice, research, the ability for you to trade assets. They may execute those trades on your behalf, and they're going to get paid commission for those transactions in most cases. Um, if you work with a full service broker, it's going to cost you. You're going to pay more because you're working with a real person or a real entity via that app, and you're paying for all of those extra services like investment advice, the research that they put out there, them actually managing your portfolio of investments, etc. So that may or may not be a good option for you depending on your budget, like what's affordable right now. You see discount broker and you probably go, well, my budget would be more friendly to a discount broker, but what is that? That's going to be an app that's providing just a basic service for you to buy and sell assets, buy and sell stocks, bonds, funds, all these things that we're going to talk about. And that's usually going to be at a cheaper rate because there's not a full service broker with the services extra that you're paying for. You are going to be, in many cases, managing your own investment or working with a quote unquote robo advisor to manage your investments. And that's just going to be AI taking over after you filled out a survey, after a questionnaire has given it the information it needs to guide you in your investments and in what you decide to buy into. Okay. So those are brokerages in a nutshell. And I know Julie is sending in some information on lists of brokers offering IRAs. We've also got financial advisors. Again, this is going to cost you more to work with a financial advisor because you're paying a real person to manage your investments, and they're also providing you with um, financial planning advice. They are helping you with your budget, your managing your daily expenses, helping you think about financing your child's future college education. Like, they're touching all areas of your personal finance. If you do decide to work with a financial investor and you're willing to pay for it, definitely look for credentials like certified financial planner, CFPs, chartered financial analysts, CFAs, or chartered financial consultants. These are folks who are going to be regulated by the Securities and Exchange Commission, the SEC, and they generally have a fiduciary responsibility to act in your best interest, which is good to know when you're giving somebody your money and you say, go invest this or help me manage this. You want to make sure that they're acting with your best interest in mind. And fiduciaries have that obligation. Okay. So I just said a lot about who you could work with or how you go about getting that file cabinet, getting the ability to open your IRA. But I still want to emphasize it doesn't have to be complicated. Open up your app store right now, type in brokerage app, look at the reviews, and download one that you are interested in. Take a look at the fees, take a look at some of the features built into the apps, ease of use. You want to make sure that this is an app that you're going to be able to understand and utilize, not just discard and feel discouraged about after you take, a first glance at it. Okay. And then get your docs in a row. You need information like your social security number, home address. You need to verify your identity as you get started setting up that account. And we'll talk about risk tolerance in a little bit, but certainly that's going to help guide you as you make your investments within the IRA in this example here. So let's talk about it. Now that you've got your brokerage app, let's say, or you've got a financial advisor you're working with, and you've got an IRA open, that individual retirement account, you've moved money from your savings account or checking account into this brokerage app, you've got it in your IRA, and you think, oh, I'm good. That's it. I've done it. I put money in my IRA. That's not it. That's not everything. And that's where a lot of folks make this mistake early in their investing experiences where they just put money into an IRA and think that it's invested. It is not until you actually buy with it. So you will choose to buy into stocks or bonds, real estate, funds, alternative investments. If you're interested in crypto, we'll talk more about that. That's a type of alternative investment. That's something that you can buy into. Okay. It's important that you make those purchases, that you invest. If you don't actually invest, the money you transfer into your IRA is just going to sit there and do nothing. It's like sitting in a checking account, except it's not accessible with a debit card. So it's like even worse, right? So it's time to start thinking about your investment mix. You're going to notice on my screen a risk meter in the bottom right hand corner. It's a little superficial, but it gives you a quick glance of the type of risk involved with these different investment options. First up, bonds, not James Bond, bonds. When you invest in these things, you are essentially lending money to a government or to a company. And in return, they're going to promise to pay you back with interest. Bonds are considered lower risk investments, in part because the government, like the US government, has never failed to repay on the bonds that it has issued to folks here in the States. They've never failed to do so. So generally, like bonds, US government bonds are seen as very low risk because there's been no history of the government failing to return or failing to pay back that interest on their bonds. They're useful generally if you want steady, predictable income, especially for like short and medium term goals, but they offer lower returns compared to some of the other investment types that we'll talk about. And so folks are not necessarily putting all of their or want to put all of their money in the bonds basket if it's not going to give them the kind of big returns that they hope for that will really allow them to generate wealth in the long term. But they can be a piece of your portfolio. And we'll talk risk and your own risk tolerance later on. But if you are somebody who is more risk averse, you may look to bonds as a way to mitigate your risk when investing. Okay. Now let's talk real estate. Where we go here? Oh, there it is. Okay. So, real estate, investing in real estate, and some of you have already done this, means that you can make money either through rental income. So, some of you might be renting a room in your house, or you've got a full rental property that you manage in the area or somewhere else, and you're making money when your tenants pay rent every month. That's one way to get invested. Or you might own a house that you're later going to sell. And when you sell it, assuming that its value has appreciated, you make money at that point. Now, some investors choose to invest in physical property, and if you can do so, you may wish to because there is a potential for return. But realistically, especially for a lot of younger folks, like you need a lot of money up front to get invested in real property, like real physical property. So if that's not something that is feasible for you, there are other options. You might opt for something called a REIT, which is a real estate investment trust, which um, kind of operate like stocks. We'll talk about stocks in just a moment, but these are pretty easy to buy and sell. And essentially, you're investing in with a company who manages a big portfolio of real estate. So they might be managing corporate centers. So you think, I don't know that I've seen too many around here in State College, but back where I'm from in Northern Illinois, there were all of these business centers and these big developments of just warehouses and or malls, for example. So these companies are managing those kind of big properties or like um, residential buildings, for example. Okay. This is as a type of investment that is allowing you to build diversity or diversification within your portfolio. So it creates a mix if you're looking to, we'll talk diversify in a little bit, but you don't want to put all of your eggs in one basket, for example. If that's your goal is to not put all of your eggs in one basket, you may wish to invest a little bit in real estate as well because it diversifies your portfolio. Now, individual stocks, let's talk about it. If you buy a stock, it means you're buying small ownership or large, depending on how many stocks you buy, within a company. And they can offer strong returns over time. So, for example, historically, we've seen stocks give an average annualized return of about 10%, which when we think about inflation being about 2%, that's like 8% we're making in profit if all numbers remain true and constant all the time, right? But as we've seen lately, stock values can fluctuate dramatically. Um, they're ideal for long term investors who can handle the ups and downs as we've seen. And they certainly can be emotionally challenging to manage, especially when the market is volatile, which is something that we've seen recently. We're in a time where the market is experiencing some uncertainty. And certainly, this can be a normal part of the investing cycle. It doesn't necessarily signal a crisis, but it does underscore the importance of having a long term plan and building in some diversification, so you are able to weather these periods of time in the market when the market is not doing so well or our investments are not doing so well. So let's talk about that. If I want to invest in companies, but I want to lower my risk, or I don't want to put all of my eggs in one company's basket, and that company maybe were to fail, I mean, I don't want to lose my investment. So instead of picking individual stocks, you could invest in something called a fund, which is a collection of investments managed by professionals. These are mutual funds, index funds, exchange traded funds, target date funds. Um, Most of these are aiming to mirror the performance of the stock market. So if the stock market is returning 8%, your fund, like an index fund, is going to try to mirror that same 8% in returns. But some funds are managed actively, like some mutual funds are managed actively, and they're going to cost more because you have professionals who are picking and choosing and moving around the stocks within that fund in an effort to try to beat the stock market returns. Okay. Those typically cost more because you're paying for that active involvement. But just know that this is a great way to diversify your portfolio because you've got a mix of stocks. You've got a mix of companies within your investment portfolio as opposed to just one. And I will say, for the investors who are just getting started, this can be a helpful place to start because it takes the guesswork out. We liken this to making sushi for the first time. You've had sushi and you love it, but you're trying to make it at home. It's like, do I have all the right ingredients? Is this going to taste good? Did I do this right? Did I pick the right stocks? Am I going to make money off of this? Versus going to see the sushi master at Tadashi who's going to make you a tasty sushi roll, right? Like that is the same thing as investing in a fund where you've got professionals putting the mix together. They generally know what's going to perform as well as the market or better because they are, of course, the professionals. So, an option for those of you who are just looking to get started and are not necessarily the most knowledgeable about individual stocks or how the market has been performing. You just want a more autopilot way to step into the space of investing. Funds make it possible to do so and build that diversification, right? So then let's round out with alternative investments. These are things that are outside traditional categories. So this is something like cryptocurrency, non-fungible tokens at the time, commodities like gas, gold, and silver, and collectibles like Beanie Babies, which my parents had bet highly on that Beanie Babies were going to be worth something one day, and unfortunately, they were not. So we had a lot of Beanie Babies holed up in our basement that we had to donate a while back. Some people invest in these things to further diversify their investment portfolios, or pursue higher potential returns, and we see that that has been possible. But they're higher risk. They're less regulated when we look at things like cryptocurrency and often more complex. I've taken a course on cryptocurrency and I still feel like I don't fully understand absolutely 100% how cryptocurrency works. So I'll say that, these require caution and research and a clear understanding of your risk tolerance before you were to invest in something like cryptocurrency, for example. And knowing your risk tolerance comes through exploration of your personal financial goals, your time horizon, how long until you need this money, what are the current market conditions. Your investor profile is something that you can generate on your own through surveys online. So there's one here from Vanguard. Julie, I forgot to grab the the URL for it. So if you're able to pull up that Vanguard investor profile questionnaire to share, I'd appreciate it. But talking with a real person or taking an online questionnaire or having AI do an evaluation is going to give you a picture of kind of where you fall on this continuum of more conservative to more aggressive. And you'll see in this breakdown of sample investment holdings, so sample portfolios, thank you, Julie, those who are more aggressive are going to have more holdings in their investments in stocks than things like bonds, maybe even a little alternative investments like crypto. We typically see folks who are younger have the ability to be more aggressive in their investing because they have more time to weather any down periods in the market. But certainly your profile is your profile, and it is not for me to say or for your age to dictate, but definitely worth exploring as it will influence what you choose to invest in. Okay. So, woo wee. That was a lot. A lot of information, and frankly, at a fairly high level. Um, Thanks, Julie. With all of this said, if your brain is spinning, whether you are staff, faculty, alum, or an undergrad, grad student, there is some way for you to get some individualized support. So, first, I want to say that if you're an undergrad or grad student or you're an alum, you can schedule an appointment to meet with us via Starfish or via our email, finlit@psu.edu. I think Julie will send that in the chat. And then those of you who work for Penn State, you've got representatives from TIAA, you've got folks at SIRS and PSIRS that you can call up and sit down and talk with their financial advisors to get some more guidance as you think about investing for something like retirement. We've got self-study modules that you can come back to as well as if you want a refresher. We've got a financial wellness bookshelf that I know Julie's going to link with a couple of books on investing. Do a little bit of self-study, read about other people's investment philosophies to help develop out your own. I think that's particularly useful. All of this and more can be found on our website, which is accessible via the yellow QR code or the link that either Julie or myself will place in the chat. So thank you so much, Julie, for that. You've been great.